So this is August 2023. Question number 1. That is the first page. So in that question, we did part A and also we did part B. We did the equity accounted value of investment, then also we calculated goodwill. So now we were supposed to go to the last one, the consolidated statement of financial position. So before we go to the consolidated statement of financial position, I would like us to determine 3 elements. Remember, initially, S was an associate, where parent was having 40% before they topped up another 30%. So when they topped up, it means they de-recognized the associate. So when you de-recognize an investment, you need to check whether you gained or you lost on that de-recognition. Very important. It will affect our retained earnings. So if it's a loss, you will reduce your retained earnings. If it's a gain, you will add. And allow me to say this. Soon, in the next exams, students will be required to calculate gain or loss on the recognition of an investment. So let's do that working. So we have 3 workings to carry out before we present the balance sheet. In exam, no need. You can just present it because you will get the maximum ticks. So let's get whether we gained or we lost. When we recognized that investment, we calculate retained earnings and also the non-controlling interest. Those 3, then we can do presentation. So this one is going to be a working 1, I believe so. This is working 1. Yeah, let's just call it working 1. So working 1, gain stroke loss on the recognition of associates. So when you recognize, because initially it was an associate, then we topped up 30 and it became a subsidiary. So there must be a loss or gain on that recognition, and which we need to determine. So you need to know whether you gained or you lost. Check the fair value of the previously recognized investments. The current fair value. Check note 1. Note number 1. In the additional information number 1, they said that currently the fair value of the previously 40% interest in S was 3,000 million. So currently the value of that investment is standing at 3. That is the market value. What you had invested initially, the 40%, right now, the 40% is having a value of 3, correct? But what is the book value? So you check the carrying amount of the investment in associates. You have it in the required A, we did it. The required A, where they said the equity accounted value of investment. The first required we did. What did we get? The current book value. We did that working. Check for me. I'm the influencer, I'll call you. So check, it was 27. We got 27. Thank you. So the book value of that investment in the financial statements, the book value is 27. But the market value of the investment, if we wish to dispose it right now, it will be disposed at 3. It means there is a gain. There is a gain. So there is a gain of 300. So this one will be required one day. That one I can assure you, though I don't know when. So if you are told to get the gain or loss on recognizing an investment, you just check the current market value minus the book value. And to get book value, you take the original investment plus post-acquisition profits or net assets. That is how you get the carrying amount. So there is a gain of 300. So with that gain, I will credit it. Remember, we don't have P&L. So when you don't have P&L, the gain or loss will go to retained earnings account. So let's get here, working 2. We are only doing 3 workings. Retained earnings and NCI, then we are done. So working 2, retained earnings. Retained earnings. Bas. So retained earnings for the growth, you will take for H limited. H limited. Check the balance sheet. The balance sheet, the retained earnings of H. So the retained earnings of H is 3490. I hope you can be able to see it. The 3490. Everyone should be able to see it. Then you add gain. You add the gain in working 1. This gain on the recognition, you bring it as income. Remember, we don't have P&L. So you credit it to the retained earnings account. So we have gained 300. So whenever you top up acquisition, this is a critical item to determine. Then for S, you bring post-acquisition. So post-acquisition profits, S limited. S limited. Post-acquisition profits for S limited. So S limited, I would want us to be very keen on it here. So S, this was 2019 when it was initially acquired. When it was associate, then it qualified to be a subsidiary. So it was associate here, then it became a subsidiary somewhere there. So to get post-acquisition, you will check when it was associate, 40% up to here, from acquisition up to here. Then when the subsidiary from here to here. So when there is step post-acquisition, you will divide it into 2. So for S, when S is associate, you will take 40% in brackets. So even before we come to 40%, we need to analyze those profits first. Otherwise, correct that one first. Then we check. If you check the very first paragraph up there, the first paragraph, not note 1, the first paragraph up there, The profit on acquisition when it was 40% was 360. Then the date they topped up in additional information number 1. In additional information number 1, how much was the profit on the date of the top up? Kindly somebody to check for me. On the date of the top up, how much was the retained profit when they topped up additional shareholdings? Yes, 860. So the date they topped up, the profit was 860. Then when we were closing, this one is the closing. Closing, you go to the balance sheet. You know, balance sheet is at the end of the year. So check the retained earnings in the balance sheet. So the retained earnings of S in the balance sheet, I'm capable of seeing 1660. So the issue here, in this period, from 360 to 860, we were having 40% shareholdings. From 860 to 1660, they topped up 30% here. So here we will take 70, but here we take 40. So it will be 40% of 860 minus 360. So give me that one first before we come to subsidiary. 860 minus 360 times 40. That one will give you how much? How much will that be? 200. So that one will be 200. Then when it's a subsidiary 70. After topping up 30, so 70 of now 860, from 860 to 1660. So you take 1660 minus 860. Tell me what you are getting. Tell us what you are getting. 1660 minus 860, then 70%. Nancy, 560. Then there were 2 items. Yeah, there were 2 of them. Check note number 2. Whoever tells me what there are 2 items I want to adjust in respect to note 2. What do you think I need in note 2? Note 2, Roman 1 and Roman. No, only Roman 1. Yes. What do you think I need in that Roman number 1? Yeah. Yeah, there was revaluation, but now revaluation, you see, we can't bring in the profit. There is something out of that revaluation, there's something I want. No, Hilda, amortization would have gone to Roman 2, but there is no amortization. The system of amortization is what I want in 2. Yes, Nancy, depreciation, yes. I wanted depreciation in Roman 2:1. They said an item of plant with fair value, it's carrying, whose fair value exceeded its carrying amount by 150. So in the that is the revaluation you are saying, the 150. On 1st April 2019, the item of plant had a remaining economic useful life of 6 years. So you need to depreciate that plant. So depreciation less depreciation. So depreciation, you will take 150 divided by 6 years. Divide by 6 years times. So that was 1st April 2019. Books, we are required to prepare balance sheet on 31st March 2023. So balance sheet, you accumulate depreciation. So 2019, 2020, 1, 2, 3 years. From 2019, April 2019 to March 2020, to March 2021, to March 20. Wait, this is April 2019. So to 2020, 1, 2, 3, 4. 4 years. So you multiply by 4 years. You multiply by 4 years. Because the fair value was in 2019, books we are preparing in 2023. So accumulated depreciation, we check for 4 years. So how much? 150 divided by 6 times 4. That is 100, just what? 100, you subtract. The last one, there was check note number. You tell me what I'm supposed to subtract in respect to note number 34. In respect to note 4, what am I supposed to subtract here to complete my issue? Less, there is an item I'm supposed to subtract in respect to note number 4. Which item is this? Just check note 4, then you let me know. Which item is appearing there? Goods, yeah, goods were in transit, but we can't subtract goods qua profits. There's something out of those goods in transit. Yeah, UPI, massive, yes. So you need to subtract the unrealized profits. Unrealized profit is what you subtract from the retained earnings. So we had calculated, did we calculate the unrealized profit really? No. Did we? No, but we can. So the unrealized profit, they said, H Limited sold goods worth 100 million to S. H Limited reported a gross profits margin of 20% on these sales. S Limited had neither received nor recorded these goods. So it means the entire goods were in transit. So unrealized profit is based on the goods which remain. So the entire value of 100 remain. So you will take 20% of 100. They never sold. They never sold. So that is 20. That is 20. So how much is the consolidated retained earnings? We are done. Unless there's something maybe you have a question on, I'll be able to answer, but I don't see anything. So can you give me the consolidated retained earnings? Consolidated retained earnings. Consolidated retained earnings. So people are getting 4430, but I was keenly checking on this depreciation. Depreciation, yes, I agree it is 100%. You will have to adjust because yes, it's 100. The answer is 100. I agree, but depreciation was in the books of S. Check note 2. At the time of achieving the control interest in S, the fair value. So this 100 is a depreciation in the books of S. In S, parent will take 70. Will take 70% of that depreciation. What are you required? So you tutakuwa overstate. So here you will just take whatever you have gotten the 100, but have 70%. Parent will take 70%. You cannot take everything. Minority must take part of it. So 70% of 100 will be 70. So please just adjust that one. Just adjust that. So it will change to how much when you make that adjustment. Josephat, 4460. Thank you. 4460. Please maintain for me that answer. I don't have space. I'll use it during presentation. 4460. Sawa. The last working is NCI. The last working is on NCI. For working 3, NCI. NCI sioni kama itakuwa kitu serious. NCI, very simple. You take their fair value at acquisition, fair value on acquisition. Check B. There is a working we did to get the fair value on acquisition required B by the examiner. We did it up there. We're going to calculate goodwill. Where we calculated goodwill, there is somewhere we determined it was a calculation we were supposed to do, and we did it. So check required B solution. So we did it somewhere, and that is the figure we need. How much was it? Our required goodwill, where we computed goodwill, we did the fair value of minority. So there is no need of wasting time. Somebody? People are giving me 1830. So fair value of minority on acquisition, they never gave it direct, but we did that computation. So check where we did goodwill computation. We got 1830. Then our number, you just add post-acquisition profits. Post-acquisition profits. So remember, NCI is only there when this company is a subsidiary. We find the NCI in the subsidiary. So post-acquisition, you only check for the period it was a subsidiary. So when it was a subsidiary, the post-acquisition profit was 1660 minus 860. Parent went with 70. Minority will take 30. So you will take 30% of the same 1660 minus the 860. 70% of that. How much? Those are the only workings we require for the balance sheet. Otherwise, there is nothing. 240 less depreciation. Depreciation was in the books of S. Depreciation was in the books of S, and therefore minority are liable. Any expense in the books of S, minority are also liable. So depreciation was this one here. So they will take 30% of 150 divided by 6 years and the 4 years. Just the same way we did this one, but now they take 30%. So they will go with how much? Actually, it will be 30 because that one I remember it was 100, our 170. So that should be 30, yes, not. So this one should be 30. Question. That is what minority should consider. Give me that figure. Help me that particular figure. $2040. $2040. I hope that is okay. Josephat. $2040. These are workings kama si required to achana nayo kwa mtihani. The only one I really want you to understand is this one. They have never brought it as required, but I'm seeing it coming very soon. Gain or loss on the recognition of associate or joint venture. Hizi zingine tutasumbua tu bure. Forget about them. Hakuna mtu hata atashughulika nayo. So don't waste your time. So let's go to the presentation. So right there, H group. H group. So I'm deleting this one here. Consolidated In case someone is not done, please, you can take a screenshot. For those who are joining now, we are doing August 2023, last sitting, page 1. The group question in that paper, which is question 1. So we have done part A, B, so we are in part C, where we want to present the balance sheet. So you can pick from there. When I share the video, it will connect, so there is no problem. So H group, consolidated statement of financial position. So this is H group. As at 31st March 2023. Yeah. So shillings are in millions. Be ready, be ready, be ready. I'm looking for my other pen. So my students are much ready. Much ready. So kazi yetu ni kukopi. Tunakopi hiyo balance sheet yao, but now tunakuwa keen, we consolidate where necessary. Some there is nothing to consolidate, so unaweka tu. So non-current assets. Non-current assets. Property, plant, and equipment. Property, plant, and equipment. 55. So, you know, S has become, ilikuwa subsidiary at 2019, before even this year. So, balance sheet, we don't even apportion. So, the kuongeza. Provided it's a subsidiary, no problem. 5550 plus 4200 plus, I want to move with you now. What do you think I should add? Let's make the class interactive. What do you think we should add to the PPE in regards to this question? In regards to this question, what should we top up on the property, plant, and equipments? Or I can give you a hint. I can give you a hint. Carol? Yeah, sure. Thank you very many. Nimepea answers mingi. All those answers are correct. The Carol amesema note 2. Mwingine ameniambia 150. Another one revaluation. Another one depreciation under charge. All of them are okay. So we add the revaluation. So 150. There was revaluation. Then we subtract. Kuna mtu ameniambia depreciation, because that revaluation, Emmanuel, that revaluation came with the depreciation. So we need to subtract the depreciation. I clearly remember depreciation was 100 in full. Please indicate in your books, the book is yours. This is revaluation, so indicate there with a red pen, revaluation. This is depreciation. If you are comfortable, give me the consolidated figure. So help me with the consolidated value for PPEs. For PPE, so people have confirmed 9,800 to be the correct answer. So I'll pick it the way you have said. 98. So we move procedurally, pole. Investment in S. In group accounting, investment in a subsidiary or associate, we don't bring them in the books. So that investment in S, I should replace it with what? There is something which replaces that investment. So I should replace it with what? Somebody? Yes, Mwende, correct. We replace that with goodwill. So investment, you know why I'm throwing these things back to you? The main reason why I'm doing that, you know, when I'm fixing things here, mtu anakuwa na ile mentality, hii kitu ni ngumu, hii kitu ni ya mwalimu. But when someone answers from your side, inakuwa challenge kwako na inafanya sasa mtu anasoma sema kumbe watu wanajua hii kitu. So that's why I'm throwing it back to you too, so that it becomes motivation on your side. So goodwill, we calculated goodwill somewhere, required Roman 2. When we started the question, there was A, B. So hapo kwa B, we calculated goodwill. That is the one we are supposed to consider. So how much was it? How much was the goodwill? We calculated it in required B, 930. So give me 930. Your attention is being drawn to additional information number 2, bullet 2. Additional information 2, bullet 2. Okay, I have a target. My target, this question must be done and finished before at 7 sharp, so that I transit and finish another question. So lazima tupande to balance. So additional information 2, bullet 2. What do you think I should bring there? There is something I really need to bring, that upon current assets. What should that be? Note 2, bullet 2. Concentrate there. The 90 million. What? Yes, I agree, Vera. That 90 million should be recognized. But what do you think? What name can we give it from your own view? What name can we give that 90 million? Yeah, correct. It is an intangible asset, the database. Correct. So there is intangible assets in bracket database. So fortunately, this database was not being amortized. So we take the whole amount of 90. So add. Mnanipatia moral. You are good. There is no problem. Mnapita kwanza ndio watu wengine kwa hii country wapite. Mtapita tu. There is no problem. Alright, so how much should that be? The addition? The addition should be how much? 10,820. 10,820. Correct. We go to current assets. Current assets. Current assets, what these people were calling me. Current assets, we have inventory. So inventory, we have 27 plus 18. But remember, there are some goods which were in transit. So you know when goods are in transit, they are not here, neither are they the other side. Zimehang. So if you don't bring them in the group, stock yako itapotea. So for accountability, those goods must be added back because they have been subtracted from the who sold parent. Parent are subtracted, the other side have not recorded anything. So you add them back. It was 100, but remember, 100 was at a profit. It was at a profit. Stock is not recorded at a profit, at cost or selling price, whichever is lower. So you subtract the unrealized profit, which was in this 100. So we calculated with you, and we determined the unrealized profit was 20. So you can indicate in your books, this is GIT. GIT is goods in transit. So 100 is the goods in transit, then 20 is the UPI, the unrealized profits. If you are okay with that, give me the figure. Mm-hmm. 4580. Next, receivables. Receivables, we have 3120 plus 2180 minus. So upper you examine what was in their head, but I'm going to be very keen. So check note 5. Check note 5, additional information number 5. Additional information number 5. Current accounts between H and S did not agree due to the goods that remained in transit as per note 4 above. As of 31st March, the trade receivables of H Limited included 600 million due from S Limited. So in the receivables, I don't know whether to separate the two or you're supposed to subtract the entire 600. You're supposed to remove the 600. But now I don't know whether to separate because of that 6, there is 100 in transit. You know, when the goods left, we are accountants, when we invoice. So already when you invoice a client, it means you have credited sales account, which is the revenue account, and you have debited the trade receivable. That's the double entry. When you issue an invoice before payment, credit revenue account, then debit the receivables account. So already in the receivables, they had included this amount of 100. Then the examiner is saying the total intergroup debt was 600. So the 600 includes this 100 which is in transit. So I want to separate the two. I don't know whether to say, okay, why I want to separate, in the 600, there is 100, but this 100 you are not supposed to subtract from payable. Because what they have received, so you cannot tell them to pay. They have not received these goods of 100. So in the payables, instead of subtracting 6, I subtract 5. I subtract 500 because of the 600, there is the 100 in transit. But you see the 100 in transit, you can't subtract because those people have not even received the goods. So you will allow me to separate the two. This 100, you subtract because it is part of receivables, then minus 5 to give you the total of 6. So this 5 is what we are supposed to subtract from payables. That is what they had, apart from whatever was in transit. But I will not have a problem. You can make up at 6, then payables to at 5. It means you are recognizing often there are 100 elements. I hope you have understood what I'm doing. You know, intergroup debts, you're supposed to subtract the intergroup debts from receivable and payables. But now the issue we have of the intergroup debt of 600, there is this 100, even they have said it includes the goods in transit of the 100. But you see the other side, those people are not received. You know, it is payable. Nikikutumia goods upoke, that is when it is payable from your end. But these goods are not even reached down there. So you cannot subtract what they have not received. So the correct balance without in transit is this 500 here. But I was saying you subtracting 6, then down there 5, there is no issue. If you have understood, give me the figure. Give me that figure there. But please, you can indicate on your own, you'll be revising. You can. I'm already consulting 1 or 5 and 6. So people are getting how much? People are getting 40. Jacinta, 48. Jacinta, why are people not confirming? Now not 47. So which is which? I need a confirmation. People are confirming the 47. So Jacinta, repeat that. So this is 47. I will proceed. Cash and cash equivalents. Yo, tulimiki sisi ya kuandika. Sisi watu wa hesabu, mambo ya kuandika vitu mingi hatutaki. Vitu mingi leta uandike huko kwa LM. 770 plus cash in transit. There was no cash in transit. So add 1170 plus 770. Yeah, 47 Jacinta, that is okay. That one will give you how much? In I think 2 over 19 some. How much will that be? 19, 2000, no. Hilda, 1900. Yeah, somewhere there. So there is nothing. Give us total assets. So can you help me with the total assets? Add non-current plus current to get the total. Let's see. Thank you. 22,000. It's a flat figure. Okay. It's rare. Since I got a flat figure like that, but it's fine. That is what we have. So equity and liabilities. Equity and liabilities. Equity and liabilities. Right, that equity and liabilities. Equity and liabilities. It's just a matter of addition. There is nothing much. Ordinary share capital. Ordinary share capital. How much? Somebody? It's just a matter of addition. There is nothing much. You just add, then you get the figures. So ordinary share capital, how much? How much? How much? Carol, Vera, and the rest, 10,000, correct. Parent only. In a group, parent only. That is where they are getting that figure. You don't add plus subsidiary. So parent only, 10. I agree. Then we have retained earnings. Retained earnings, check working 2, the one we have just done. There's a figure you got, so it can be, there are so many conversations, so you will post it again. How much did we get for the retained earnings? Retained earnings, what did you get? Joy, 4460. 4460. Then total equity, but before you bring total equity, you must bring non-controlling. Non-controlling interest. Non-controlling interest, working 3. Working 3, yes. Working number 3. What did we get for noisemakers? Non-controlling interest, we got a figure of how much? $20.40. We got 20.40. Can you add for me the total equity? There are only this plus that will give us how much? 3 minutes. How much will that be? $16,500. Thank you. So that is $16,500. Non-current liabilities. Non-current liabilities. We have 10% loan notes. 10% loan notes. Hapa kuna issue, so you just add 18 plus 12. 18 plus 12, you need 3,000. That one I can add. That is 3,000. But the group in a wanga raisi, mutakuja kujua group, okay, it is just overrated. It is just overrated. But it is difficult, but it's not. Once you understand the nitty-gritties, like this one, you just needed to know. You will tell me, what do you think was the main issue with the question? And then current liabilities, payables. So payable student will be 1560 plus 840 minus the intergroup debts. Intergroup debt total was 600, but of the 600, there was 100 due to goods in transit. The in transit, haikufika kwa payables, so payables are only subtract 500. Yes, that is it. I will only subtract 500. Not the 6. 6 because either one. One I go and pick up chini. So haikuji hapo. How much? How much? How much? How much? Somebody? Mercy? 1900. So 1900. Then we have current tax. Current tax, there is no adjustment, so just adding 350 plus 250. That one I know. That is 600. Finished. Can you check whether we are accurate by getting for me total equity and liabilities? Confirm our accuracy. Lim 22, just like this one. So that is okay. So that is also 22, meaning we are very much accurate. So what do you think was the main issue with the examiner? Alikuwa anataka kuangalia nini in that question? Allow me to hear from your side. Anyone can unmute. What do you think the examiner was focusing on? Watu wengine wataki kuunmute. You just say anything. Kenye umeona ingekuwa challenge kwako. I can see Jacinta as unmuted. Yes, Jacinta.
Like the competition of trend receivables. Yes.
Yes, that one I agree. That is one of the areas, but from the start, I don't even see what was the issue. Sioni, maybe those small issues. I don't see a major. Or Nyabuti, there's something you have seen you want to say?
The examiner was testing whether the student knows when to consider the company a subsidiary and an associate.
Yeah, that one was quite also a concern, but now it could have been, actually that was their main issue. Lakini ingekuwa mzuri, ingewekwa within the year, within the financial year. But you see, this one happened in 2019, the top up from 40 to 30. So it means when we are getting to the 2023 year, already it was a subsidiary. But that was their concern. But you see, a student angeona, hii ilikuwa 2019, sasa tuko 2023. So it means when we were starting already it was a subsidiary. So the addition, but that was the main concern. Then those small things like transit and the rest. So this question was marked at 7 and 2. That is how it was marked. 7 and 2. What did it mark? Yeah, it was 14. The balance sheet was 14. It was 7 and 2. So 7 and 2, I can tell you what students got without any issue. They got this one here, 1, without overstatements, 2, then ordinary, 3, then there was here cash, that is 4, then which one? Which one else? Sasa nyinyi mniambie. Kwa hizo zimebaki, which one was gettable without struggling? Which one could you have gotten? Anyway, me, I don't like overstatements. So without overstatements, without struggling at all, any student who appreciates consolidation, of course we struggle, I know. By the time we have even this one, you will get PP, you can get this database, the intangible assets, even it came from your side. This one you will get without problem, even this inventory. But now without doing any adjustment, without adjustment at all, student was to get 8/14 here. Then part 1, the 2 marks, hiyo ilipotea. Then part 2 on the 4, goodwill, the purchase consideration was hapo tuliona we could get 2 marks. So on the minimum side, mtu hakuwa amestruggle kwa hiyo swali, without struggling at all, will have gotten 10/20. Group ukipata 10/20 uko sawa. Very, I know. Hapo uko sawa kabisa. Because hata adjustment zitakuja baadaye. So thou shall not fear. Thou shall not fear group accounting. So that was last sitting, August 2023. Unless someone has a question or a concern, allow me to go to April 2023. It was still the same concepts. So allow me to go to April 2023. So open that question. Class ends at 9. Najua kuna wengine ikifika tu 8. Wamechoka, wanasema wacha tungoje recorded. Nitascroll mpaka kwenye niliachia. Tukae hapa, mlikalisha hapa, tufanye mpaka hiyo 9. Ikifika 9, we are good. Remember I gave you the guide. So we are working with time. Losing even 1 hour will be costly to us. But kama unataka kwenda mbio ningeacha hii step acquisition hiyo one question tuende kwa nyingine, but now what is that? Let's be thorough as we observe time. For April 2023, which question? Somebody then, I know it was step acquisition as well. I just need to know which question. Tuangalie. Question number 2. Let's meet there. Let's meet in April 2023. April 2023. Question 2. Question 2. This is page 8. Page number 8. Allow me to read without wasting time. Zura Limited, really? No. The following are the summarized financial statements of P Limited and S Limited for the year ended 31st December 2022. So statement of financial position, as you guys can see, statement of profit and loss and other comprehensive, also you can see. So when are the dates? Group by them, be very careful on the dates. 31st December 2022. So that's a financial year which starts on 1st January. January 2022 to 31st 2022. Perfect. Additional information. P Limited acquired 25% of S on 1st January 2021 for shillings 24.40 and exercised significant influence over the financial and operating policy decisions of S. So significant influence means S, up to where we are, S is considered to be what? Up to that sentence where we have reached without thinking of so many issues. Before tuendelee mbele. Up to there, S is considered to be associate.
Associate.
Correct. Associate is where we have significant influence. The fair value, not to, the fair value of S Limited identifiable assets and liabilities as at 1st January 2021 was equivalent to their book value. S Limited reserves stood at 69.60. I think there was an issue there. It was supposed to be revenue reserve. It stood at 69.60. It was supposed to be revenue reserve, not just reserve. Revenue reserve. Revenue reserve is the other name for retained earnings. I think I've not mentioned that before. Revenue reserve is the other name of retained earnings. So wakitaka kuvalisha retained earnings white, inaitwa revenue reserve. So let them not confuse you at that stage. Number 3, a further 35% stake was acquired by P Limited in S Limited. P Limited in S Limited on 30th September 2022 for shillings 50,40,000. Okay. The fair value of S Limited identifiable assets and liabilities as at the date was shillings 11,040 and S Limited's revenue reserve stood at 93.60. That is the retained earnings. As at 30th September 2022, S Limited's share price was shillings 14.5. Up to there, we can get some evidence. Can you come up with a number line? So number line, the financial year is ending on 31st December. It means it must start on 1st January. They added additional shareholdings on 30th September. So initially, before the top up, it was 25%. Then they topped up. So top up 35. So moving forward at the end of the year, we are talking of 60. So the top up happened during the financial year. This is the kind of a question I wanted. Unlike you, allocating was quite easy because the top up was even done before the year. So it means when we are starting, things are okay. So this one happened during. So before the top up, it was associate. So it was associate from here to here. These are 9 months, January to September. So it was associate for 9 months, then subsidiary for the remaining 3 months. Please let's humble ourselves to write that. So S is equals to 9 months associate, 9 months associate, 3 months subsidiary. How that? Actually, this is the question. When there is step, hii ndio swali hii unaona hapa, this analysis. Hizo vitu zingine tutatusumbua hapo, sijui unrealized profits, sijui what. Those are just stories. But the question itself is this. Once you get this correct, you will get those things I'm telling you, the 3 marks. You will just get them without struggling. All right. So now, how will we consolidate? Up to this stage, I don't know what is going to be required, but I'm just doing the analysis. So in case we are going to prepare profit and loss account, P&L, I will take the parent, P&L, parent, plus subsidiary, but subsidiary I'll only take for 3 months. You will time a portion. Subsidiary, you only take, S you only take when it was a subsidiary. For profit account, we only consolidate for parent and subsidiary. That is what you need to know. Not associate, not joint venture. We only consolidate for parent and subsidiary. You only consolidate where you have control. Control exists at 51%, unless otherwise. Unless otherwise, you know what I mean. Unless otherwise. So you will take P plus S, but S you will consider for the 3 months period. Good. I want somebody, you can unmute, you tell me, how will we consolidate for balance sheet? CSFP, Consolidated Statement of Financial Position. How will we go about it? You just tell me P plus what, Evo. So how will we go about it? Mercy, I can see you have unmuted.
Full, parent full, and subsidiary full.
Correct. Parent full, subsidiary full. That is how we are going to consolidate. Do you know? Ukijifanya mtu sawa ni wazimu, utaki story mingi, you want to consolidate. And you know this, you can even ignore all those stories which are waiting for you ahead there. And the likelihood that you will pass that question is very high. Because there are things there which does not even require adjustment. The current tax, the deferred tax, the finance cost, deferred tax, current tax. There are things which they will not even require adjustment. With this one only. So this is the most critical part of step acquisition, that analysis. But I've seen to go sour. Something else which I would want you to draw for me again, a number line, because it is going to catch up with us ahead here. Do this, call it RE, the retained earnings. But then you're before top up, after top up, all those stories. So check for me, the retained earnings when it was acquired at 25%, what was the retained earnings, which they are calling revenue reserve? So it was what P? Where was not one? Really not one, no. Not number two. Not two, as limited reserves stood at 6960. So 6960, when they were acquired, when they were associates, this was the retained earnings. Check on the date of top up. Check on the date of top up. On the date of top up in note number 3, the revenue reserve was now 9360. Check balance sheet. Balance sheet at the end. Balance sheet is always the end, the closing. The balance sheet, retained earnings of S. Revenue reserve is 9480. I hope you can see it with me.
Between the
Yes.
difference here.
Mute yourself, Mercy. 9480. So that one, just leave it like that. Time yake itakuja, where now we'll need this space, we'll need this space. So just that one, just hold it for now. Thank you. So let's proceed. Number 4. The differences between the fair value of the identifiable assets and liabilities of S and their book values was due to brand. The brand was estimated to have an average remaining useful life of 5 years from 30th September 2022. So your brand kama ile ingine tulifanya. There's a question we did of that nature. So you will just check the fair value of those assets minus the book value. The difference is brand. That's what we're going to do. Income and expenses are assumed to accrue evenly over the year. Evenly means uniformly. Uniformly means proportionately. Proportionately means equally. So what they are saying, when they say that, they mean, they are even giving you a clue that income and expenses should be time apportioned. That is what they are trying to say. When they tell you evenly, means they were uniform, proportionate. So you need to time apportion, which already we have captured. Neither company paid dividends during the year, and neither issued any shares in the summer. P Limited elected to measure non-controlling interest as at the date of acquisition at fair value in the summer. There is no impairment loss on goodwill, while amortization of brand is classified in cost of sales. So in this question, they have said amortization should go to cost of sales. If they were silent, amortization and impairment, I want to see whether somebody can answer that. What if they were silent on amortization? Where we have captured it. Where we capture impairment is where we capture amortization. Mercy? Yes. Administrative. So if that was not mentioned, then amortization and impairment are classified as administrative expenses. What we classify to cost of sales without any direction is depreciation. Depreciation is what we take to cost of sales. Thank you. Required consolidated statement of profit or loss and other comprehensive, 10 marks. Consolidated statement of financial position, 10 marks. Well, so I have like, let me check. I need to get the current investment, the gain, goodwill, then NCI. We have like six workings. 6 workings, which I think we can do them to make our work very easy. We have like 6 workings to do, then our work will be easier. So let me just do those workings, then we do our presentation without any problem. So we start with which one? Which one would you want me to start with? In fact, which one will you want us to start with? I have like 6, So yenye mmesema ndio tunaanza nayo, nikiona mmekuwa exhausted is when I'll bring the other one. So Mercy is suggesting that we start with the goodwill computation. Yes, we can start with goodwill. Am I saying, kwani kila mtu ni wa goodwill? Sawa. Let's start with goodwill. So working one, let's start with goodwill computation. So have there goodwill as our first working. This one was just analysis. That was just analysis. So goodwill, as you know, purchase consideration. So purchase consideration. So purchase consideration, when there is step acquisition, no kila mtu akwe hapo kwanza. Purchase consideration, when there is step, you bring two of them. Two, and I want you to see how the two is coming. Don't cram. Let's just be very objective. The two, on this date, you know, initially, when it was associate, there is money we paid. Kuna pesa tulilipa. Then on the date of top up, when we are topping up additional shareholding, again, we are adding something. So you must recognize those two. What was paid by them and what we are topping up. So you bring the two of them. The only concern you need to know again, the one which we paid by this time, you know now goodwill is computed here when it became a subsidiary. Goodwill is calculated when it qualified to be a subsidiary. So we are calculating here. The investment on this date, what we invested on this date cannot be the same on this date here. It must be different because it is increasing. It is increasing in value. So it cannot be the same as the date of acquisition. So you come here and say, the fair value, we call it fair value of previous investments. Fair value of previous investment. So what we invested initially, what is the current market value? Because you cannot say what we invested here can be the same up to this stage. Never. It is increasing value. So you take the market value of this date, then that date again you check the top up. So when you check note one, P acquired 25 in January 2021 for 24.24. So that was by that time. So we need to know the fair value of this 24.24 today when it qualified to be a subsidiary. So I noted when we were reading, hawakutupatia, but there is something they gave us which can help me. Check note 3. A further 35% stake was acquired by P in S Limited on 30th September 2022 for 50/40. That is the addition which we are going to add there. The fair value of S Limited identifiable assets and liabilities at that date was 11,040, and S Limited revenue reserve stood at 93.60. As at 30th September 2022, now that date when they were topping up, S Limited share price was 14.5. So when they fail to give you the market value of the amount they invested, then we don't struggle. We don't struggle with them. Remember, when you go to the balance sheet, please check the balance sheet. Check the balance sheet. Under equity, share capital, the par value is 1. But you see now the market value right now when they were topping up was 14.5. So you will use the shares. You know the shares is what they acquired. So do the valuation of the current market value of those shares. That one becomes the market value. So you will say 25% times the value of their ordinary shares. Their ordinary shares are trading at 14.5, but how many shares do they have? So multiply by the number of shares. So they failed to mention the market value of the investment, but they have given us the they have given us the market value. But you see, we had acquired 25% by that time. So you take 25 up to this date times 14.5 times the number of shares. Check the balance sheet. The shares of S is shillings 960. So 960 divided by shillings 1. So you value for me that. That becomes the fair value of the previous recognized investment. Where they fail to give you the market value, they will give you the value of the shares. So take the value of the shares times the initial investment value. How much will that be? How much? Somebody? $34.80. Thank you. $34.80. Good. Then you add additional investment. That one we were given. Check note 3. I want you to tell me how much. Refer to note 3, then you tell me the figure. How much did they top up when they acquired the 35? How much did they top up? The top up. Vera, 50-40, correct. 50-40. Then read note number 6. Read note number 6. Read note 6. P Limited elected to mention and controlling interest as at the date of acquisition at fair value. At fair value. So, fair value of NCI. They are not mentioning, they are not giving us the value, but they're just saying they elected to measure at fair value. So perfect. When again they fell, what is that? I don't know what happened with my net. I lost you. I don't know what happened, but fine. We are back. My net, I think, my net dropped or something. But we are okay. I was saying, they have not given us the fair value. They have just said they are measuring at fair value. So if that's the case, when they fail you to give you the fair value of NCI, just check the market price of the shares. The same with this one here. So check the market price of the shares. So NCI will exist when it's a subsidiary. When it's a subsidiary, the parent is having 60. So the minority, their proportionate share will be 40% because parent is having 60%. So you will take 40% times the value of the shares. So the value of the shares is shilling 14.5 times the shillings 960 divided by shillings 1 to get the number of shares. So that will be the value of the minority. Somebody might ask, where is the 40 coming from? After the top up, 25 plus 35, parent is having 60. So minority will have 40. 25% is the previous investment when it was associate. So don't confuse between the two. How much is that? How much is that? $55.68. 55.68 less net assets. So can you check for me note 3? What was the value of net assets on the date it became a subsidiary? Check note 3. The value of net assets on the date it became a subsidiary. How much was the value of net assets? Goodwill you compute when it qualified to be a subsidiary. So even the net assets you check on the date it became a subsidiary. Mercy is saying 11,040 in note 3. Yeah, it is 11,040. So subtract 11,040 40. Kwisha. The difference is goodwill. The difference is goodwill. How much is the goodwill, ladies and gentlemen? How much is our goodwill? Please don't copy. Kama kuna kitu unaona unaandika tu because of the sake, usifanye ati utarevise baadaye, hapana. I'm here for you. So tell me the value of goodwill. Goodwill have been given to be 30, 48. 30, 48. Nani ako na swali kwa goodwill? We are done with the goodwill. This time around it was not required. This time around it was not required. What's a question on goodwill? Yes, Emma? You can just unmute.
Yes, Mwalimu. I think on that first part, I haven't understood well on the part of fair value on previous investment. Maybe
Yes.
you can repeat.
Sure. Now, when dealing with the step, unajua kwa step, wana invest mara mbili. They're investing twice. Just for an account to NCI, they're investing twice. Okay, now let me go to, I don't know how tradition behaves, but you know, tradition differs. Let me not go to others. Let me go very specific. When a man takes dowry, then maybe they have agreed to divorce. There is always that provision that dowry, especially in our place, the dowry should be refunded. Nafai kuwe refunded. So, on the date, let me call this one the date of acquisition. You paid a dowry of 2,000 shillings. It can be 2 million for avoidance of so many zeros. So 2,000 shillings, and this one you paid back in 1975. That is when you paid the 2,000. Then now the divorce has happened in the year 2018. Unajua wezi rudi hapo wanakuambia wanakupatia, we are funding you your 2,000. You know the 2,000 was the cost of investment. You cannot get back 2,000. Emmanuel, I hope that is true. Of course, you will get something a little bit higher. That higher is the current market value of that 2,000. Connecting that back, these people, initially they are invested. They are invested a certain amount. It was 24 in note 1, check note 1. They invested 24. Then they start down again and they agreed. So wow, hakuna divorce. They have agreed to top up another one. So we are giving you more shares. In fact, we are adding you 35%. So when calculating goodwill, what you need to understand, goodwill you calculate when it qualifies to be a subsidiary. So it qualifies to be a subsidiary somewhere here. So it means you will have how many investments? 2 of them. The one you are topping up right now, which it seems I want a problem now, this one here, the 50-40. The problem comes on this one here, the first one. The question we did, the one for last setting, they mentioned, they gave us the current value, but here they have denied us the current value. So it will be very wrong for you to say that initially we have paid them 24. You know, 24 we paid back in 2021. We are topping up in 2022. So you need to check what is the current market value. And by the way, what are you acquiring in that company? You are acquiring the shares. So in the event they are not able to determine the market value of your investment, Then we check what is the market value of your shares. Because when we acquired your shares, even maybe the price was just 1. Right now, the market value is 14.5. And that was the main reason why the examiner was giving the 14.5. So to avoid a lot of stories, Emmanuel, just mark it this way. In the event the examiner fails to give you the market value of the previous investment, then the market value of shares should be utilized to get that value. So you just say, currently, the shares are at 14.5. But how many shares do we have? We have 960 divided by par value of 1 to get the number of shares, which is just 960. So you take 960 times the current market value. But you see, we never acquired everything. The previously, we had only acquired 25%. So you'll only take 25% of the current market value of the shares. That is when you are not given, because otherwise, to tell me now to invest money, kitambo 25%. So we are topping up and we need to assess new goodwill. We cannot take that previous investment because it inaongeza value, but we are not able to. But their shares, we can check the shares. They are now, you see Safaricom in the year 2, I can't be exact, but around the year 2000, the shares were trading at shillings 4. So you unasikia ziko 20 something, ziko 30 something. So we check the market value of shares, we multiply with the percentage which we are acquired. So Emmanuel, before I go to Josephat, but Josephat, the beauty is the explanation is going to be more or less the same. Emmanuel, are you at least somewhere?
Yes, I think that's now understood.
Good. Josephat is almost the same. When they don't give you, in any question, not this one only, when they don't give you the fair value of minority, then always do valuation for the ordinary shares. Hapo kwa shares ndio tunakutana, parent and share wanapatana hapo kwa shares. So just check the current market value. Not the current, the market value on the date when it became a subsidiary. So the examiner just said, in, I don't know, note 6, they just threw a word there that they are measuring at fair value. And they're not giving us the fair value. So in any question, moving into the future is tomorrow and even to tukiendelea. In any question, the examiner fails to give us the fair value of minority, and in the question they are saying they are supposed to use the fair value, then just do valuation. Do the valuation of the market value of the shares. So the market value is the 14.5 number of shares, but minority were entitled to 40%. 40% is after 25 plus 35. Parent is now having 60, minority will be having 40. Josephat also confirm to allow me to proceed.
Yes, it's okay, Mwalimu. Understood.
I propose the next working we are doing. I said I have 6. That is just 1. Someone can propose another one. Until I'm sure I'm exhaust, then I'll come up with the ones I'm thinking. So someone to bring up another one. Somebody, working Zico, you have to have them. Hey, Hilda, where umeenda huko? I will hold on the retained earnings kidogo because of something. I need to check gain or loss on the recognition. So I'll check the one for brands, which Emmanuel and Mercy are saying. So once we get the Akina brand, I will again check whether we have gained or we have lost. Then I can do retained earnings after that. Still, I can do it, but now it was squeeze and it won't come out very clear. So let's determine the value of the brand. So for the brand, I want you to read note number 4. Let's check note 4, as said by Emmanuel. Let's check note 4. Let's check note 4 for our working 2. The brand. We need to know the value of the brand. They said the difference between the fair value of the identifiable assets and liabilities of S and their book value was due to brand. The brand was estimated to have an average remaining useful life of 5 years. So, fair value of net assets That is on the date of acquisition. Date of acquisition as a subsidiary, not associate, as a subsidiary. So the date it became a subsidiary, which is 11,040. That is the fair value. It is 11,040. You compare with the book value. So book value of the net assets. Of course, I want to compare. That one they will not give you. You have to do a computation. So net assets is the value of ordinary plus retained earnings on the date of acquisition. Those two. Those ones, I can bring them here. Ordinary share capital. I don't know each one, 960. 960 of the subsidiary. Retained earnings. Retained earnings on the date of acquisition is this one. The 9360. It was provided in note number 3. Retained earnings on the date of acquisition, 9360. You know, shares doesn't change. So your balance sheet, upon profit keeps on changing, but ordinary is equal to constant. So you pick 9360. We subtract, the difference is the brand. So 960 plus 9360 will be how much? That plus that, 10,320. 10,320. So how much is the brand? The difference between the fair value and the book value is the brand. How much is our brand? 720. 720. So that brand is on the date of acquisition here, when it became a subsidiary. Then they are amortizing. So amortization will be 720. They are amortizing for how many years? 5. So you divide by 5 years. But you see, whatever answer you are getting is per year. But this subsidiary is only 3 months old. So you will multiply by 3/12. So how much is amortization? How much is amortization? $36. Now, hold it safe for me. It will be applicable when necessary. Correct. Where are we headed? I want to check whether we gained or we lost. When we dropped the associate, you need to check whether you gained or you lost. That is a must. Because you are having 25, we topped up another 35. So it means we are dropping the associate and bringing subsidiary. So at that stage, you must lose or you must gain. So you have to assess. So working phrase is to check whether we gained or we lost on the recognition of associates. That one should be assessed. You have to check whether you gained or you lost on dropping the associates. There we go. So to know whether you gained or you lost, simple. Take the fair value, the current market value. Fair value of the previous investment. That was working one. Working one. Check for me your working one. I've deleted. What is the current market value of that previous investment? It is how much? Check for me that. 34.80. So this was 34.80. Sawa. Then you less the carrying amount. The carrying amount, you can just say carrying amount to date. Hiyo kizungu kimekuwa mingi. The carrying amount of that investment to date, that one is going to be quite simple. See ngumu as such. So the carrying amount to date, you check the initial, the original investment. How much was the original investment? Original investment in that company, check note 1. It was 24.24. Then you add post-acquisition profits. You add post-acquisition profits. Yeah. You add the post-acquisition profit. Profit they made since the date of acquisition. This one here. The difference between this and this. This one here. This and this. Yeah, that is true. So you take 25% of that. So you take 25% of 93.60 minus 69.60. So you increase your investment. If you check last sitting, this was required Roman 1. This one here. You kutoka tu hapa kwa carrying amount. The equity accounted investment. This one. Leave alone the gain. That was not required. This one was required Roman 1 of last sitting. If you check this one here, if you check that one, you will realize that is what we are doing. So what is the 93.60 minus 69.60 by 25%? What will that be? So that is 600. So it means currently the book value of that investment right now is 30.24. 30.24. We have gained. That is a gain. A gain of how much? That is a gain. The gain will be how much? Gain will be how much? 456. Where? 456. Tuna option hapo, lazima tupitie. Haya. Now, who was that? Hilda. Now we can do retained earnings without any problem. So, working number 4, we are almost done with the workings. So working 4, retained earnings. This working, I don't like them in exam. They waste a lot of time. Usually ni hapa hii, wewe fanya hiyo kusoma. Lakini hapa, you know why I have to do them? In exam, you can find this one required from 1. Determine gain or loss on the recognition of associates. Alafu zidi kwa class, tulikuwa nasema that one leave. It can bring a lot of problems. So I want us to calculate the retained earnings for our working 4. So these workings, I do them in case it is required. But if they are not required, they will waste your time. So retained earnings. Retained earnings, remember we are preparing balance sheet. So you go to the retained earnings in the balance sheet of those companies. That is what you need to check. Well, maisha imekuwa dangerous. So the retained earnings you will take for, this is P Limited in the balance sheet. How much are you seeing? Just sometimes nakuwa najiongelesha online mambo ni mingi. How much are you seeing for the retained earnings of P balance sheet? Balance sheet of P, people are seeing 47,904, correct? 47,904. Then for subsidiary, you bring post-acquisition. So post-acquisition profits. Post-acquisition profits. So in this question, post-acquisition profit, check here. You know, post-acquisition means since the acquisition from here all the way. But now which percentage will you use? Because here was 35, here 60. So you have to separate the profit they made when it was associates and when it was a subsidiary. You know, the previous question, when the year started, it was a subsidiary. So here you will separate when it is associate and when it is a subsidiary. So you say S Limited associates. S Limited associates. So when it was associates, you will take 25% for this difference here and here. So you take 25% of 9360 minus 6960. Then S Limited as a subsidiary, you will take 60 of this one. This was 9480. 9480 minus 9360. Yeah. So can you give me those two answers? So you separate it when it was associate and when it's a subsidiary. Parent is entitled to all those profits. Give me the two answers. Help me the two answers. Why? It's dangerous. Help me with the two answers. I'm waiting for the two answers. 600. Then the other one is 72. So this is 600. This is 72. Then you add this gain. So add gain on the recognition. We got 456. That one you will add the 456. And finally, there was amortization. So you less amortization. Amortization, I remember, it was in the books of S, and it was 36. Amortization was 36. So they will share 60% of 36. Parent will take 60% of 36. You don't retain earnings in a conga ya parent. What is due to the parent? So you take everything. How much is that? 60% of 36. 60% of 36 is likely to be how much? 21.6. Kwisha, kuna kitu ingine hapo. Can you give me the consolidated? People are getting 49,010. 49,010.4. Working 5. NCI. NCI's equity. Unajua NCI inakuanga mara mbili. Kuna NCI equity and NCI's profit. Those two. So after this, we are doing the NCI profit, then we are done. Hakuna working nyingine hapa. As we move by, itafika mahali nitakuwa napata some workings in presentation. So NCI's equity. So NCI's equity just takes their fair value on acquisition. Fair value on acquisition. Those part ile ulikuwa nauliza. Working 1. What was the fair value of minority on the date of acquisition? It is something we did. We took 40% times 14.5 times 960. What did we get? That's fair value. You have it somewhere. You join 55, 68, 55, 68. Then always top up to them the profits which came after acquisition. And the profit which came after acquisition is this one here. Parent has taken 60, minority will take 40. So post-acquisition profit, you know, minority, they are interested in the subsidiary. They will take 40% of 9480 minus 9360. And because I don't want a lot of write-ups, I want to subtract this amortization here instead of bringing it down here. But you can indicate in your books minus 36. So indicate in the books 36 is the amortization. Then give me 40%. What will you get? We are on time. My concern was that 1 hour, we do the working. The other 1 hour, presentation. So each presentation should. When you present P&L can take us 30 minutes. No, it should be less than 30 minutes. We can finish before 9 if you give me the answers promptly. But don't we move step by step. That is 33.6. 33.6. So how much is the total? How much is the total? So that is 5601.6. So the last working we are doing is to check the profits for the minority. That is the last, then we do the presentation. The last, then we do presentation. So say they are working 6. NCI's profit share. NCI's profit share. That is the last concern. NCI's profit share. So NCI's profit share, you will take PAT. They normally take profit after tax of the subsidiary. Minority are always, wow, working a minority is subsidiary. So they normally share the profit after tax of the subsidiary. How much are you seeing? The PAT of subsidiary. Pick it from P&L. Check P&L, then pick it from there. P&L, pick it from there. $384, correct. So 384, I agree, but S was not a full year subsidiary. So minority cannot claim the whole 384. They will only claim 384 for 3 months. S was a subsidiary for 3 months. So minority will only, they qualify to be a minority after the top up. So only for 3 months. How much is that? 384 by 3/12, which is 0.25. You get how much? 96. Less amortization only. So amortization was 36. Amortization was 36. I remember. EVP is a pattern. This is 60. Therefore, NCI will take 40%. 40% of 60. That is what they will take in their books. What is 40% of 60? 40% of 60? 40% of 60? 24. Yes, 24. Finished. Presentation itakuwa sasa walkover. Lakini me, I don't encourage. Please, aki usiende kwa mtani kufanya hii kitu. Me, I'm telling you the truth. If you follow that direction, you will get it wrong. I only follow this direction in case it is required. Unajua kama iko required, bas kila mtu ako hapo. Hakuna kutoroka. There are some questions I can even tell you around 20, this is 2023. In the year 2022, I can show you that question. Required Roman 1 was to calculate NCI. It is there. So you just need to know how NCI is done. The chances, kila mtu in the whole country will get it wrong. The chances is 99%. But now what will make difference, anything you post correct will earn you mark. So at least ukiona fair value and acquisition, you can put, then it was 2 marks. So watu wote kama wameanguka, wewe peke yako ndio umepata, si wewe peke yako, wenye wako kwa hii class. Wewe ndio umepata hii one check, wanasema watu wameanguka, so that 1 times 2 na ushapita. So at least you know how to go about it. For the purposes of time, let's go to P&L. So right there, P group. Right there, P group. P group. Consolidated. P group consolidated. Statement of profit or loss. So please be ready to give me the working. You tell me working 1, working 2 with the figures. Accounting. So P group consolidated statement of profit stock loss for the year ended 31st December 2022. So how that one? Shillings are in thousands. Shillings are in thousands. I recommend in the exam, once you have seen the 9 and 3 months, nobody marks those workings. They have never been marked. I don't think if soon they will be marked. So your presentation is what is subject to marking.